Hello and welcome to another episode of Bell Financial Group's From the Helm series. I'm Grady Wulff, Senior Market Analyst with Bell Financial Group. We've just wrapped up reporting season for FY25 and the foundations are there for a really strong FY26. So investors naturally are shifting their portfolios into growth areas of the market, and that's exactly where the REIT sector comes into play. Now, instead of talking to just one fund manager today, we decided to bring in two fund managers from Centuria Capital Group, one for the Centuria Office REIT and Centuria Industrial REIT. Belinda Cheung and Grant Nichols join me now to discuss the outlook for these two portfolios, what investors are seeing and why they are such a compelling investment opportunity in FY26. Grant and Belinda, thank you for joining me today.
Cool. Thanks for having us.
I will start with you, Grant. Now, for our investors who may not be aware of the Centuria Industrial REIT, REITs are coming back now. Can you give us an overview of your portfolio and how it's been performing in recent years?
Yeah. So thanks for asking. As mentioned, CIP is a real estate investment trust. So when you are buying CIP units, you are effectively buying a portfolio of industrial assets. Now, CIP has got 87 assets across Australia. So it's a very diversified portfolio. It's predominantly urban infill. So what we mean by urban infill is that we are in areas with very, very limited land supply, which is very good because that's where we're seeing the strongest tenant demand and strongest rental growth. Now, CIP's performed very, very well over the last couple of years. We've been delivering some very, very strong releasing spreads, in some instances of up to 100%. So what we mean by that is that the rent that we were achieving prior to a new lease commencing was 100% lower than the rent we've achieved on the new lease. So there has been some very, very strong tailwinds coming into our portfolio, which hopefully is going to generate some very, very strong earnings growth into the future.
Belinda, same question for you, Centuria Office REIT. Can you tell us about office REITs recently and how your portfolio is comprised?
Yeah, definitely. So the Centuria Office REIT is a portfolio comprised of 19 office assets. These are 19 assets located around metropolitan and near fringe markets. So not your typical office markets within CBDs.
Like we're in right now.
Like the one we're in right now. They're located in markets like in Metro Sydney, think North Sydney, St Leonards, Chatswood, places that are quite close to like residential areas, maybe some industrial areas, just a lot of mixed use. These assets, office has been challenging over the last few years, especially since COVID. I think the entire sector has been, it's been changed quite a lot. But what we have noticed is offices that operate in the metro markets are actually quite resilient. And like a really good way to measure this is net absorption. So we've looked at net absorption statistics over the last 5 years, and it's been a lot more stable, a lot more resilient than some CBD markets, purely because of the types of users in these metro markets. So you've got users that are large corporates, you've got lots of government use, 75% of COF's portfolio is comprised of government, ASX listed, multinational tenants. So it's got some really good quality blue chip tenants that make up these buildings. It's been probably challenging to date, but we're definitely seeing a lot of improvement in these markets. There's been quite a few drivers of these, one being cost of construction has been extremely high. No one's really building office anymore. It's becoming increasingly difficult to justify building new stock. And I'm sure we'll dive into this more a little bit later, but withdrawals as well are really becoming a big trend in office, I guess, leading to the natural recovery of the office market.
So obviously recently we've had the back to work policies implemented. None of us kind of expected that to come in, but a lot of companies are forcing workers back to work. Are you seeing a decrease in vacancy rates as a result?
At the moment, it's probably a little bit too soon to say.
Okay.
However, what I will say is last August, so August 2024, the New South Wales state government brought in return to office mandates for government employees. And I think that was a major turning point. Up until that point, a lot of larger corporates hadn't really come out too much and said anything about return to office mandates. But since that started rolling in, we've seen the investment banks, a lot of other large financial institutions, and also large corporates now come out and mandate their staff to come back a certain number of days a week. We do our own tenant engagement survey every single year, and we ask our tenants, what are your intentions? Do you want to increase space? Are you happy with the space? How many days a week are you asking your staff to come back in? And each year, like since 2022, we've seen this increase year on year. And now the majority of our tenants, being over 70% of tenant respondents, have said that they're in the office at least 3 to 4 days a week.
Perfect.
So it's fantastic. I mean, I think as an office landlord, you sort of need to understand, or you accept that hybrid working is here to stay.
Yeah.
But what you really need to make sure you have on offer is good product, good quality office that attracts employees back to the office.
Exactly. Now, Grant, infill, as you did mention, infill industrial was a great place to be pre-COVID, and post-COVID we're seeing a bit of an uptick in that again now. Based on supply and demand, obviously. Now, what's setting up the tailwinds for the sector, you did say, and what sets Centuria apart to outperform peers?
Yeah, it's a really good question. I think the demand for urban infill is really driven by e-commerce adoption. Yep. So I think all of us are getting more and more packages delivered to our home. I can confirm. Yeah, every day you go home, you pick one up.
Yeah.
But you think about that, industrial tenants might be closer to their consumer because it reduces travel time, but it also reduces transport cost. So there's been a significant increase in demand for urban infill industrial real estate. Yeah. Now, as mentioned before, urban infill industrial real estate, when we're referring to that, that means that there is virtually no land supply. These are very, very constrained markets. So when you're looking at national vacancy rates at the moment, the urban infill national vacancy rate is about 2.4, whereas it increases to about 4% for the urban fringe. Okay. So there is a material difference in terms of not only the supply dynamics, but also that vacancy rate. So you're coming off a much lower base in the urban infill market. Further to that, we see about 70% of leasing velocity. So 70% of leasing transactions occur in a unit size between 3 and 10,000 square metres, which is consistent with the unit size we see in urban infill markets. Now, why this is relevant for CIP or Centuria Industrial REIT, 85% of our portfolio is located in urban infill markets, and our average unit size is about 7,500 square metres.
Straight in the middle of that.
That's exactly right.
A dream.
Exactly. So the CIP portfolio has definitely been curated to be located in markets with limited supply, but also to be a size that attracts the greatest amount of leasing demand. So we think there is really, really good opportunity for both continued rental growth and valuation growth within the CIP portfolio.
Absolutely. Now, Belinda, kind of mirroring that, what does the forward supply pipeline look like? You briefly touched on the lack of offices being built. How does this kind of bode into the tailwinds and fare for tailwinds for the sector, that, in your opinion, for COF?
Yeah, so there are two key factors when we think about the future supply of office. First is new developments. Yeah. They're becoming increasingly expensive. We're not going to see very much, especially in the metro markets. And the second being withdrawals of office. Yeah. So I think I might just hone in on that point first, because this is not something that's very well discussed at the moment because it's still quite early on in the process. But we see, like, especially in the metro markets, there's good quality office, but then there's also a very large portion of the market that's made up of C, D grade buildings. So secondary grade, very old, likely vacant market. That sort of, it's inflating the overall vacancy number in that particular market. And over time, the valuation of these assets would be coming down. Yeah. Like over the last few years, there's no doubt that it would come down. The landlords of those assets are now thinking that there might be better conversion use. And given that we're in a housing crisis at the moment, it makes a lot of sense to start converting these assets. And some government organisations like the Transport Oriented Development Regime or the Housing Development Authority are making it very easy for these offices to be converted for alternate use. Yeah. So if we look back at the last 5 years, about 65% of office withdrawals were for office redevelopment. Oftentimes, if they took back office, they'd produce even more office, being quite high density, going up multiple levels. Whereas we're looking at the next 5 years of office withdrawals mostly being diverted to alternate use. Apartments, there'd be build to rent, there would be build to sell, so other residential, even life sciences, data centres, education. There are so many other uses now, and it just, to me, it makes a lot of sense to do that because there is a lot higher value, or a lot more value in those other sectors than there is in that part of office. Yes. So once we start seeing these being withdrawn from the market, there will be displaced tenants. And we've already started seeing these displaced tenants coming out to market and looking for new office accommodation, because they're seeing these demolition clauses being put into their leases. It's not giving them any security around their future in that accommodation. So they're coming to market and we're benefiting. So existing landlords of good quality space, like for us in St Leonard's, we've seen quite a bit more leasing activity driven by these displaced tenants looking for space. Absolutely. So I think it's only going to aid the office recovery journey. And Collins did a really good piece on this recently, looking into Metro Sydney. And we're interested in Metro Sydney because about 27% of our portfolio is within this Metro Sydney region. And they're saying that by 2030, with all these withdrawals, with limited supply coming out of the ground in the future, we're actually expecting metropolitan Sydney vacancy to fall to 8.7% from 23% where we are right now.
Yeah, absolutely.
So it's a significant change in a relatively short period of time. If you think about real estate as a long-term investment, there are significant tailwinds to be seen.
Now, I'll touch on both your different portfolios, but with pricing, obviously incremental price increases ensures margin expansion across different portfolios. How do you factor in margin expansion and increasing prices when you've got tenancy kind of headwinds that are now turning into tailwinds?
Yeah, look, I think when you're setting rents, you really need to be cognizant of where you're at in the market. So for CIP, obviously having an urban infill portfolio means we're in areas where there is very, very strong demand.
Yeah.
So that is allowing us to increase our rents. But also when you think about rent as a component of total industrial operating costs, rent is about 10% of a standard industrial operating cost. So arguably an industrial tenant can pay more rent to reduce their transport costs. So I think it's a bit of weighing up what is the most important thing for their particular business. And most tenants want to be close to their consumer. They want to be close to their employment base, and they can facilitate paying a slightly higher rent to accommodate that. So we don't have any pushback on the rents that we've been able to achieve. And due to the very, very constrained nature of the assets we own, we think there is some really, really good opportunity for rental growth into the future. The CIP portfolio at the moment, we estimate to be about 20% under rented.
Wow.
So there is going to be some strong tailwinds, earnings tailwinds coming to the CIP portfolio in the future.
That's what investors love to hear. Now, Belinda, how do you factor in price increases into rental agreements as well?
Yeah, so generally, like when you think about it anecdotally, rental increases are quite difficult to achieve in a market where there's high vacancy. However, it's happened. It's happened across a lot of different markets around Australia. I think we've noted 14 out of 19 markets around Australia have experienced rental growth in this last half. We've definitely noticed it across our portfolio, and our valuers have also taken that into account into the last cycle of valuations. And as a result of this rent growth, we've actually seen the portfolio reach stabilisation levels.
Wow.
We recorded an $18 million gain in the second half of FY25, which is, it's quite a pleasing result because it's the first period of valuation growth that we have seen since FY22.
Absolutely.
And but I think it sort of comes back down to what I was saying before about a lot of these metro markets at the moment. There's some low quality stock. Once you take that into account, maybe the vacancy levels aren't as high as they appear.
Yeah.
And at the same time, if you've got good quality stock, there's going to be demand for it. So I think it's a combination of that, but also high replacement costs, high fit out costs, high cost to occupy overall will continue to drive rents up, albeit maybe not as high as some of the industrial rents that we're seeing.
Industrial is definitely what investors are looking at for the data centre front right now. But offices, it's good to hear. I think a lot of investors might misunderstand that there's low quality stock. Like I had no idea there's low quality stock that's probably going to come off the market soon anyway. So that really does drive the demand supply equilibrium imbalance at the moment. So
yes, definitely.
Yeah. So how do you remain competitive? So competitors obviously have access to this limited market as well. What's your competitive edge for the portfolio?
Yeah, well, at the moment, the way I think about it, our portfolio, even the vacant suites, they're all fully fitted. Wow. So any tenants that are looking for office space at the moment, I think it's really hard to bring someone to a completely vacant suite and ask them to imagine, can you see your employees coming in here every day?
That's definitely the old days, right?
That's the old days.
Imagine this.
These days it's a little bit different. I think it's really important to embrace what you currently have. We really focus on being quite sustainable financially, but also environmentally, keeping what you have, refurbing it, and then allowing your next tenant to come in, see what's already on offer, and maybe they can use an incentive to polish it up a little bit more, to make it a little bit more personalised for their business. But typically what we have on offer is already fitted space, which I think is financially quite compelling, and that I think is our competitive edge. At the same time, Centuria is an organisation, like we're not just a fund manager. We've also got the asset management arm, the property management arm, and the facilities management. So I truly think tenant engagement is also a really big part of our business and our offering. And I think tenants quite enjoy that. So we've got pretty high tenant retention rates across the portfolio. And I think that's part of our competitive edge.
Now, Grant, you have acquired some assets that have marriage value with neighbouring properties. Can you explain to our investors what that actually means in the strategic view on taking that approach? Yeah.
So CIP's worked to establish our urban infill portfolio over a number of years because it can be really hard to get set in urban infill locations. There's a lot of smaller units, there's quite disparate ownership. So to actually get set in these markets, you need to be both very patient, but also when the opportunities do arise, you need to be very nimble. So the benefit of that is that we've been able to consolidate a number of land holdings within urban infill locations, and we've increased effectively our footprint within those markets. Now that has two key benefits. Firstly, it allows us to control leasing within those markets. So we can actually potentially push rents harder than we otherwise would, but also we can facilitate tenant growth aspirations. So if a tenant is growing within our portfolio, we do have other accommodation in the vicinity that we can move them to, which will allow them to stay within the Centuria stable, but also meet their growth requirements. So that's a very, very key reason for wanting these large land holdings in urban infill locations. But probably the more prominent reason would be that it does provide us with opportunity into the future. So we can either redevelop our existing properties, make them more contemporary and charge a higher rent, or we can completely knock down and rebuild. And that would allow us to look at things like multi-storey industrial or much larger scale industrial and urban infill locations, but also to look at alternate uses. So a lot of industrial land is the lowest value use you could have. By consolidating land holdings, we might be able to look at more high value things like residential or potential data centres.
Data centres are where it's at,
That's right. That's right.
Everyone wants to hear data centres these days.
Well, if you think about data centres and where they can potentially be located in metro areas, it is always really urban infill industrial locations where they have the most relevance. So the CIP portfolio has a number of sites that we're actually looking at potential data centre use into the future, and we're hopeful that will be very lucrative to unit holders.
That was my next question. How's the data centre expansion looking for CIP?
Yeah, so it's a bit of a slow burn in that to get a site where you can look at an alternate use for data centres, you need to meet a number of criteria, most significantly getting a power allocation and a very significant power allocation.
And the water and the infrastructure.
That's right. Now, but the benefit of a lot of infill locations is that infrastructure is generally already in place.
Perfect.
So you may actually have a few hurdles already covered or passed that allow you greater opportunity than some of our peers. But beyond that too, CIP already has a data centre exposure. About 12% of our portfolio is already data centres, existing data centres. So we've got operational data centres already within our portfolio, but notwithstanding that, we think there is a lot of opportunity for data centres in the future.
Definitely. Now, Belinda, what does the next 12 months look like for COF? And looking forward, what is your next strategic move as a portfolio?
I think for us strategically, it's always been about leasing. We need to continue to lease to improve the portfolio. I think there are key markets that we're really, really focused on, St Leonards and Docklands in particular.
Oh, okay.
And I think in this last financial year, we've already seen some wins in those markets by being able to do quite a good amount of leasing in those more challenged markets. But at the same time, I'm feeling quite optimistic about some of the other markets that we're exposed to. We've got quite a few assets in Brisbane, in Fortitude Valley. There are some expiries coming up in those markets, but I see those as really great opportunities to capitalise on all the rental growth that we're hearing about in those markets.
Booming up there right now.
It's very buoyant. It's very buoyant. And there's quite a lot of leasing inquiry as well. And it's just, I guess it just points to there's so much infrastructure growth in that Brisbane market. Population growth is also an extremely strong story, not just, I guess, like across Australia, but I think Brisbane in particular is going to experience a lot of that growth. So it's happening across all industries, across defence, across mining, and professional services that support those industries. That's where we're seeing a lot of those leasing inquiries from. So going forward, I think over the next year, definitely a big focus on leasing, but sticking to what we're good at as well, continuing to build these relationships that we've got with existing tenants to maintain high retention, but also improving the quality with the assets that we've got. It's already really good quality portfolio, 93% are A-grade assets, and A-grade assets in metro markets are pretty much as good as it can be. So I think, the focus is to continue leasing, focus on retaining existing tenants, but finding better opportunities to maybe increase rents where we can.
Exciting 12 months for investors out there. And Grant, same for yourself. What does the next 12 months look like for CIP, and what's your strategic focus right now?
Yeah, so for CIP, I think we've been a bit frustrated with how CIP has been trading over the recent period. In FY25, CIP sold 4 assets at an average 12% premium to book value, but at the same time, CIP continues to trade at a 10 to 15% discount to NTA. So we think there is a pretty significant disconnect between what we're seeing in the direct market and where equity markets are valuing CIP. So in order to close that gap, CIP has is conducting a buyback of its units. So there was a $60 million buyback announced at the full year results, and we're going through that process at the moment. But beyond that, I think really the focus for us is to continue to harness the tailwinds that are coming into industrial markets. So as mentioned, CIP is about 20% under rented. We want to continue to see some very, very strong releasing across our portfolio, which will hopefully deliver some very, very strong earnings growth into the future through FY26 and into FY27. So I think, the focus is really trying to continue to harness those tailwinds and close that NTA gap.
Interviews like this one are so important for our investors to understand the different offerings in the REIT space, because REITs can be quite often everyone puts them into one pile and says the headwinds are for every single person in the sector. So it's really great to have you both in today. Grant and Belinda, thank you so much for joining us for From the Helm. I hope you enjoyed that episode as much as we did, and I hope you gained greater insight into the Centuria brand across their different portfolios.